Okay, thank you for coming. For me, it's really a pleasure to introduce Pablo Olivares from Toronto Metropolitan University. Pablo is a good friend of mine. He graduated his PhD in the University of Havana in Cuba, and then now he is at Toronto. He has been visiting professor of several universities. His topic is applied stochastic models, and he has over 40 publications, articles and publications in several important areas, and he has contributed with the new generation, over 60 advisor as PhD, master, and undergraduate, licenciatura, we say. So it's really very pleasant for me to introduce Pablo. He's going to talk when finance meets the environment. And thank you for being here, Pablo.
Thank you so much, Wilfredo, and thanks everybody for coming in the middle of the World Cup. Brazil got eliminated, but I hope that Argentina will make up for us. Well, and so my talk today is about applications of financial instruments to environmental problems. So can you hear me? So I have divided this talk into several topics. So first, I will start with an introduction to the problems in environmental finance, just to give you an incomplete overview of what is going on in this topic. Then I will start discussing with you some particular models and methods I have been investigating lately, and in pricing the temperature contract and precipitation contracts. And so that would be I don't know if I will have time to discuss with you this switching levy models, which is my latest research. So this is a talk with in collaboration with my co-workers, Villamor from Florida International University and Javari from Toronto Metropolitan University here in Toronto. So as Wilfredo mentioned, my background is mostly in the stochastic processes, probability. Then I start when I come to Toronto. So first, back in home in Cuba, I worked in the modeling epidemic processes and some biological and medical applications. But then when I moved to Canada, so financial models and financial problems were very in demand. So I moved to this kind of models in financial, so stochastic models in financial, which is my current area of application. We have a group at Toronto Metropolitan University, was former Ryerson University. It's this third largest university in Toronto. So University of Toronto is a well-known university. Ours is smaller, and but still it's large when it becomes a number of students and research activities. And then we created a program, an undergraduate program in the mathematical finance, which has been very successful. So we have these two programs, our department, applied mathematics and mathematical finance, and also we have a master and PhD program in applied mathematics, which includes mathematical finance. So, so you can see here you can see my email if you want to mainly. So we are in a kind of transition. So this that's why my email still has the name of Ryerson, the former name of the university. This is my webpage also. And then you can email me if you want some information. Okay. So I will start with a quote from one of my favorite writers, so Mark Twain. Says, everybody talks about the weather, but nobody does anything about it. Well, actually, it's not completely true nowadays, because there are some people working in trying to tackle the risk of due to climate change and global warming and in general weather events, in using these financial instruments that already exist in the classic financial setting of pricing pricing some financial derivative contract and based on financial assets, as stocks, exchange, and so on. Okay, so that is indeed what I am going to present today is how this method that already exists in the classic financial context can be translated into problem with that deal with climate underlying variable. There are some similarities, but some differences. Okay, so please, you can ask me anyway, anytime you have questions or something that you want to find out. Okay, so this is it's a nice picture about how the weather can impact an amusement park. And obviously, the economy is subject to weather risk. So in general, and for example, typically farmers, they heavily depends on the weather issues, and they would like to hedge versus this negative adverse weather event using some financial instrument that exist. And well, for example, you can see, excuse me, so it's some sectors in the economy can be seen that have an obvious impact. So whether weather has an obvious impact, for example, agriculture that I already mentioned. So the energy industry is actually the first contracts, environmental contracts were created in the energy industry. So dependence, let's say the winter is very hard, then the prices for electricity will increase and so on. So airlines, construction companies, tourism, municipal government, etc. But they have a clear impact. So weather have a clear impact in these areas. And this is according to the U.S. Department of Commerce. 35% of the United States economy is affected by weather. So it's a big part of the economy. So it's about, in 2017, was about $17 trillion that are in risk due to the weather events. Also, I would like to mention there's a website, which is the Weather Risk Management Association, which you can find there a lot of information about the management of weather risk, and also the course offering kind of which companies are offering this kind of product. Okay. So some problems in environmental finance. Let me just mention a complete list of this problem. Well, the one I will discuss today, which is the pricing of weather derivative contracts. And so basically these are contracts that are based on the underlying climate variables such as temperature, precipitations, and wind, and also we have, for example, catastrophe bonds. It's a big market as well. So these are bonds which are based on this event, for example, flooding, hurricanes, wildfires, and these negative weather events. And also there's a carbon emission market. It's not in North America, but in Europe and in China, there are large carbon emission markets where this, let's say, companies have quotas for carbon emission, and if they are below this quota, so they are allowed to sell the right to pollute to other companies. So there's secondary markets, which is called ETS, this in units, and again, so the price for these ETS units and also contracts on this units. And well, in general, so there are people studying the incentive for the introduction of green technology, which is so-called real auction that exists already. So it's not auction, not the fictitious options as derivative in the financial market, but real investment, and then how to introduce the incentive to create more opportunities for green technologies. And finally, in general, so it's a big field now, it's studying a portfolio of investment in companies with an active so companies which take into account the environment, and so that's a positive position toward green economy. So there are a lot of studies in this area as well. So these are just examples of 5 topics of where the financial instruments are used to face the risk in the environment. So this is an emerging area, as one was mentioning. So this is it's an emerging area. It's not relatively to the amount of money that moves in the stock market. It's not very large so far, but there is a need for that. And specialists say that are saying that with the all these climate issues we have nowadays, so this area of finance will increase in the forthcoming days. So it's a reasonable assumption. I'm sorry, Wilfredo, I think we have somebody waiting for a mission in the program. Okay, thank you. Okay, well, so this is a general picture. Let me focus now on pricing temperature contracts under levy noises. This is one of my recent work. First, let me tell you that everything started in Chicago. Okay, so in Chicago was created in 1973. Was created the first market for trading option contracts, so which are it's called derivative contract because it's not only the trade of stocks in the market, but contracts based on the value of the stocks. So this and then immediately a month after that, so economists and mathematicians created the first model how to evaluate this contract, which is known as the Black-Scholes model. It's a very famous model. Okay. So in the case of environmental contract in particular temperature contracts are contract that depends on the temperature in several different ways. These are the most popular contracts in regarding the climate underlying variables. So typically, for example, the most known contract is what's called the accumulated average temperature on a period. So you count the number of days, and then you look at the temperature, the daily temperature, which is an average of the maximum and the minimum this day. So and then you add up this all these temperatures. This is the accumulated average temperature for a period, let's say typically 1 month to 1 year. And also we have the heating degrees days, which are days above certain threshold. Typically when the 65 degrees with Fahrenheit is when the air conditioners start working.
So Pablo, you have a TKs, independent, identically distributed random variable. What are the conditions about TK?
Yeah, I'm going to talk about that. Yes, that's a very good question, but essentially no, let's say, because temperature, you can imagine, so the temperature today depends on the temperature on previous days.
Yeah.
So they're not independent random variables. So well, these are the typical 3 indices, and the contract that exists are traded in 20 major cities around the world. Chicago is one of the most important ones. And so typically they sell a contract. So what defines a contract? Well, there's several things that defines a contract. One thing is the payoff. So typically, let's say you want to buy protection versus weather events. So you buy a contract giving you this amount of money. So this is high T is the accumulated temperature. Is the accumulated temperature is above certain threshold, you can pay the difference times a quantity here, which is standard, $20 in most North American markets. And but if it is too hot, you get paid this quantity. If it is too cold, you get paid this quantity. And then in that way, you get protection from eventual losses that you will incur. Let's say you're a farmer or a contractor in the construction sector. So for eventual losses, you will suffer due to weather conditions. And then what this is so X plus is the maximum between 0 and X and 0. So if not, this is normal summer, let's say, you will not get any money. But so the thing is that this is general for any contract evaluation is the question how much you have to pay for that. Okay, and there is another point of view, is the point of view of the investor or the person which is selling the contract. So by how much should I sell this contract? Okay, and what is the price of the price of the fair price of arbitrage price of this contract. So I'm sorry if you are familiar with this theory. This is very well known from this classic finance approach. But basically, this formula is easy to understand in the sense that, so let's say this HKT is a random quantity, so something that I will get at a maturity, so at the end of the period. So the right price is the average, the expected value of this quantity under certain probability known as risk neutral probability. And this is the discounting factor that is very common in finance. So you are going to receive a future quantity. So you have to compute the present value of this future quantity, because you need to pay upfront an amount of money for this contract. Okay. So this is the mathematical problem that we're facing here. So we're facing for in the pricing of any financial derivative contract. So we have to compute the unexpected value under certain so-called risk neutral or equivalent to martingale measure here. Okay, so what typically this is what you get. So I'm sorry, and this is a typical, so it's nothing different from the classic finance. This is a typical combination of what it's called a call option and a put option. So it's Strandal or contracts called, which is a combination of put and call. So you have to compute, basically you have to compute this integrals. This is the integral of the payoff for each of the two parts in the contract. And this is the PDF, so probability density function of the accumulated temperature. Now the problem seems very, very easy, but this quantity is unknown. So you don't know the PDF in the of the process. And then you have to make some assumptions. So that's your question with Fredo. So we have to make some assumptions about the model. So about the temperature process itself, then to be able to say something about this PDF. Okay. Well, it's in this sense, I think. I'm sorry, no. This is my next slide is like a map, just to put you in the map. So this the market for derivative contracts. It's not derivative in the sense of calculus. The derivative contracts is huge. So you can see derivative based on which the underlying is. And then so one small part of this market around the world are weather derivatives. And so weather derivatives are based on temperature, as I said, precipitations, well, and wind, or hurricane. So this is hurricane is less developed market. So there's no market. Some of these contracts are sold over the counter as well. So that's the hurricane contract are sold over the counter, and so then we have this basically the thing. So wind is harder to capture. So to establish a model for wind is not very developed market. So as I said, but temperature is the most developed market, and then precipitation you have some contract about precipitation. So this is the state of the art today. Oh, and let me comment something important, which is the difference with the insurance of this type of events. So this insurance, the insurance approach or actuarial approach, I should say, is complement with this one. So in the sense, so actuarial approach analyzes the catastrophic losses of so it's under very low frequency events that occurs that once they occur, the losses are huge. This is a kind of relatively higher frequency events. There's a lot, but the losses are not as big as in it's catastrophic event that insurance companies assume. So there's something in between. Okay. Although that's what they have in common, that they care about the losses. Okay, so there are several methods to compute this price. So on one, we were talking about the Monte Carlo simulation that you have done some this approach. There is another approach. Sorry, excuse me. Yes, woman. Yeah, go ahead.
No, I just because you mentioned my name, so I just start off and yeah.
Sure. Okay.
No question, just because you mentioned my name.
Yeah. Okay. Yeah. Sorry. Yeah. Well, no, I was saying that. So the first model that was developed was on the assumption of a geometric Brownian motion, so which is the so-called Black-Scholes model, and then there is an exact solution of the price for this model. But in general, that is not an exact solution, and so moreover, there are several ways of computing this risk neutral or equivalent to martingale measures. And so the problem, especially for an environment, the problem environment contract, the market is incomplete in the sense that there are several ways in which, infinitely many ways, actually, in which you can build this equivalent martingale measure. Okay, so anyway, so simulation, as a Monte Carlo simulation is good, but it's very costly from the computational point of view. So it takes a long time to get an accurate solution. It's complicated, and still you need to know the PDF. That is not. So there are some association with PDEs and PIDs, so partial integral differential equations. I have a paper recently accepted about that. So using numerical method, you can solve the associated PID, which is and the link is due to the Feynman-Kac formula or Kolmogorov equation if you want. So you can always associate the price of this product with PDE or PID, and then you can solve numerically PID and you get the solution. And there are Fourier transform methods. So method based on Fourier transform and Fourier expansion method. That's what I'm going to discuss today. And then some ad hoc approximating techniques that have been developed. Okay. So then, so coming back to the formula, what we need is a good model for temperature. Then to compute, be able to say something about the cumulative temperature, and then to compute the price. So that's the way. So this is a type of data you face in this kind of model. This is what we're developing together with my colleague in the FIU. We are developing a model for contracts for the Everglades. So we look at the temperature in Everglades. So we have 15 years of the data. The data is available, so the daily data is available. It's not very clean, so you have to clean up all this statistical procedure to get the data. But you see, this data tell you that there is, of course, as expected, there is a strong stationary component in the temperature, and well, it's hard to tell from the series itself, but we can see that, for example, the volatility or standard deviation in stat is not constant upon time. So it's a time dependence of the volatility that is kind of mean reversion to this seasonal component in the temperature process. So there's kind of features that we want to have in a model with this temperature. So that's why this stochastic differential equation models in continuous time, stochastic differential equation models are built for the temperature to explain the dynamic of the temperature. So typically, so you see all these components. So ST is a seasonal component, and then you have a mean reversion to the seasonal components. Alpha is the mean reverting rate, and then we have a background noise. So that's is multiplied by time-dependent volatility, and typically, so these standard models start assuming that the background noise is a Brownian motion, but we have changed to a Levy process. Well, together, actually, there's a pioneer work that's for the first in introducing a Levy process, and then there is this is two professors from Alberta University in Canada. They also studied the Levy process, and it's our paper. Also, in our paper, we have introduced a specific model which is called the time-changed process. BT, so it's a subclass of Levy process given that way. So BT is a Brownian motion. So it's a Brownian motion subordinator to a so-called subordinator. So it's a non-decreasing and positive process because that plays the role of time. It's very popular in economy and finance, in the sense that it accelerates or decelerates the time randomly. So it's introduced with something that is which feature in the models, which is the stochastic volatility. So this changes so this artificial time is random. So stochastic process, another Levy process, then for positive because time, but it's accelerate or it's accelerate, for example, in crisis or normal time in finance. So it's very easy to handle this model. So there are several advantages in case you're not familiar with Levy processes. So there are several advantages in using Levy process at background noise. One is, as opposed to the Brownian motion, is trajectories are discontinuous. So you can think it's in a Levy process as a sum of a Brownian motion plus random jumps, essentially, but plus a drift. And so it's an advantage, but from the technical point of view, there are advantages in the sense that the characteristic function or Fourier transform of a Levy process is available, so, or it's relatively easy to compute. Okay, so then we can say something about the PDF via the characteristic function of the process. Okay, well, the solution of this stochastic differential equation is very easy to see by using the formula, which is given by this expression here. So T hat is just the temperature process. One, you subtract the stationarity component, which is just what we did is it says we apply a regression model just to fit the parameters, and then we subtract from the process, so you get this this is a generalized process, which is given by the integral of a Levy process. So actually, then we need to compute the characteristic function of the integral of with respect to Levy process. So because as I said, so the characteristic function of the Levy process is available, but not the integral of this characteristic. So we find, in looking for the characteristic function, we found a formula which exists for a long time in the literature. So I think they were the two first authors. The first paper where this formula applied is a formula that allows us to compute the characteristic function of the integral of a Levy process, which is in terms of the log moment generating function of the Levy process. So if we know the characteristic function, this is just a Riemann integral, easy to compute. So we use this formula several times to compute then the characteristic function of the temperature process. The other element here in the pricing is how to select the equivalent martingale measure. So as I said, it's an incomplete problem. So we have infinitely many ways of doing that. And one way we use one technique. So we use Escher transformations, which basically, so this says the PT is the probability. It's called his so-called historic probability, which is the probability, the real probability driven the temperature process, and then we change the measure to Q. So QT is a measure which is absolutely continuous with respect to P, and this is the density function. This is a very well-known transformation probably you're familiar with, which is the Escher transform. In this case, for stochastic processes, it's known in several contexts. So it depends on the parameter theta. And there is an important paper in Gerber and Chu. So it's something that's better known in the actuarial world. So in the sense that it's for actuarials have used this transform for other purposes. It's called Gerber-Shield transform, which is and in this paper they relate the choice of this measure with the an optimization problem following 13 utility wealth functions. So there's a justification for to select this measure as well. So so that's what we use in this case. And then we found in our paper you can find the version in the archives, Cornell archives, we find the value of theta that makes the discounted temperature process a martingale, because that's interesting. You're not familiar with the method in mathematical finance, is that there is a very strong link between martingales and risk neutral probability. Therefore, the pricing of this kind of derivative, because the idea of a martingale is the idea that it's a sequence of a process that tend to remain constant on condition of expected value. So this is the ideas of risk neutral environment is related to this martingale. It's interesting. This martingale, or Wilfredo knows way better than I, these martingales appeared for decades at the theoretical branch of mathematics. It's interesting in other sense. For example, it has limits. The sequence of martingales limits under very wide conditions and so on. But now, so in like 50 years ago, a connection was established with finance, in the sense that they use martingales to build this risk neutral environment to select these equivalent martingale measure. So the details, you can see details. We'll skip the detail here because this is pretty straightforward how to do this. So this is a martingale, so temperature, so this is counted, so the tilde means discounted, so divided by the risk-free assets, or the increment of the risk-free assets, and then so we find the expected value so it's the condition to be martingale, the constant as specified in our paper, and then so using the characteristic function we can establish this condition to be martingale, so which is a condition on theta. So condition on theta. So with out of all this possible Escher transform, we select the one that converts the discounted temperature into martingale, and then this is quite nonlinear equation that can be mostly solved using numerical method. Okay, so and then we move on and we can compute the characteristic function of the temperature process and the characteristic function of the accumulated process using first we use the formula I already mentioned before. So you see this is a three factor, or this is T1, C2 are two constant. The more interesting factor is IT, which is a Riemann integral based on the log of the moment generating function of the Levy process associated with the temperature process. So the idea is, you can see the proof in our paper is it's based on three basic steps. So one that we can go from the characteristic function phi of the subordinator to the characteristic function of the time change process on the historic measure. And then it's very easy. That's the beauty of the Escher transform, that we can compute the characteristic function on the measure Q based on the characteristic function, or simple transformation of the characteristic function on the historic measure of P. So, and therefore the log of the moment generating function. And then once we have the characteristic function of the temperature, we can compute the characteristic function of the increment, because one of the nice properties of the Levy process is the increments are independent. And with Fred, I think maybe I can answer part of your question. So we use this way of writing the cumulative temperature process as a linear combination of the increments of the temperature process that are independent. So we transform the temperature itself into the increment of the temperature processes that are independent. So the characteristic function of the accumulated temperature is just the product of this. Is the product of the characteristic function of the increment of the temperature process that can be computed using the properties of the Levy process and this formula I already mentioned. Okay, so we developed the case of a gamma subordinator. So the time, let's say the fictitious time is for the gamma process. It means the increments are have a gamma distribution, and then so we can compute all what we need. So the log moment generating function, and then this is the equation with respect to theta to get the EMM. And this is the final, this is the equation, well, the constant as specified in our paper. This is a non-linear equation of theta, but with the Newton-Raphson method, we can solve for theta. Okay, and so the second method we follow is the inverse Fourier pricing. So it's a method for Levy processes are very convenient because again, so we avoid the knowledge of the PDF. So we work more with the characteristic function or Fourier transform if you want, and then so the price can be written as a result of Carr and Madam for a Levy process can be written in terms of an integral that depends on the characteristic function of the accumulated temperature. That is known. This is what we found, and this is the Fourier transform of the payoff. So H is the payoff, and this is like a damping factor because for the existence of the inverse Fourier, we need to make sure that the characteristic function that the payoff is an L1 function. So that's this damping factor is introduced as numerical things, and then use a fast Fourier transform that can be computed very efficiently this price. The second, this is the one method. The other method is then, so once we know the characteristic function of the characteristic function of the accumulated temperature, what we can, instead of computing the inverse Fourier transform, we can expand. So we can take a Fourier expansion of this of the PDF. This is a method developed for classical finance and for Fang and Osterly. It's a sequence of paper. The first one is 2008. And so we expand. So this is a real valued function. So that's why it's only cosine appears. So we expand, we do the Fourier expansion, and then the coefficient of the Fourier expansion depends on the characteristic function we already computed. So there are some, of course, some numerical approximations we have to make, and we have to be careful about that. For once, that we have to truncate the series, the Fourier expansion, and then we have to go to truncate the integral of the coefficients. Okay, so you see, this is a result. So numerical. So this is not for the Everglades. This is for Pearson Airport in Toronto. So the temperature, of course, the airports is the ones, the places where temperature is measured, and then we have the series of the temperatures in Pearson Airport in Toronto, and which is, and this is so the blue line is the seasonal component, and so you see, so we simply do a regression analysis. The linear part is very low, so the slope is very small, so it doesn't count here. And then we capture this seasonal component. Then we subtract this seasonal component. We get a time series without this component. That is the other. Just to mention, we don't have time for that. So just to mention another problem we have worked with is with precipitation. So again, with the Everglades series, this is the amount of rain. It's a series of 15 years. Also, daily series amount of rain. And the model is a little bit different for precipitation. Is somehow simple, it's simpler, but on the other hand, it's more complicated in the sense that, well, so first you have days where there's no rain, so it's, and other that where there is some rain, so rain has to be positive quantity. So what we did is we the cumulated precipitation now is it's the sum of a product of a Markov change, which is 0, 1, whether it rains or not. And then this is the amount of rain, even that it rained, it's the amount of rain, which is described by a subordinated process. We found that the gamma distribution again provides a very nice result. This result, and one of my students wrote a recently thesis on that. Is things available in the UFT. If you're interested, we can. Sorry, in the CMU. But you're interested, I can send you. You can find this the result. So it's what I must say that now to compute the Escher transform, so the equivalent Martinger measure, we have to pay attention to the Markov chain and also to the process RT. But on the other hand, so it's more simpler in the sense that we have just a sum of processes that we don't have a stochastic differential equation. And so again, we have computed the characteristic function now based on the transition probability matrix of the Markov chains that drive the days where it's of rain or not. And and then again, so we have result about the pricing of the model based on rain. And the third one, so I finish with that, is that we also consider, or some people before us considered like a switching, the so-called regime switching model. So it's a temperature process. It is commuting or changing randomly between two regimes. Okay? And so it's a typical switching model that exists. Our contribution was that, again, we introduced a switching between Levy models, so time change Levy models, which are not considered, as far as I know, have not been considered. And then this is what the stationary process is linear combination sine and cosines. It's a linear term as before. So it's a working paper that probably in 2 or 3 weeks we will post on the Cornell website, or you can, it's almost written, so you can email me if you want. So in case you're not familiar with switching processes, so which is driving the switching, the regime switching is a Markov chain, there's two positions. In this case, you have to simplify. So 2 positions. So 2 regimes, and as before, so we have a solution by each solution of the stochastic differential equation, but now it's more complicated because so we have different regimes. So it's a sum. These taus are the time of regime change, which are random, and so we have this sum of this time for every time the process changes. Basically, this is a change from regime 1 to regime 2. So we have 2 processes, 2 Levy processes here. And so NT is the number of changes from on the interval 0t, which is random. So while this adds more work here, so we computed the probabilities to observe an even number. It depends on whether it's an even or a number of regime changes. And so this is in our paper, this constant. and then we compute the characteristic function of the process under the equivalent Martinger measure as well. So again, the constant, and I didn't write the constant here, but the constant are specified in our paper. We found these constants. And so we condition on this number of changes, and then we compute this, what is called the occupation times, in case you have seen other papers about the switching models. And therefore the range, so you have a range switching model as well, which is just you switch of switching, for example, thinking it's rainy or dry season. And so we have this is the amount of rain, and we can follow the same approach, the similar approach. So in this case, for the switching levy, there is a result from Tverdovsky that allows us to provide the characteristic function we found, characteristic function of the switching levy process of being studied, and it's available. So this is for the rain, it works. For temperature, we need the integral of switching levy, which is more complicated. Is what we did in my work with the board. So I think it's done. So thanks very much again. If you have questions, so that's.
I have a quick question. I'm just wondering, which kind of programming language do you use when you try to do Monte Carlo simulation? Or, sometimes you do Fourier transformation, you also need to do some, computation. So which programming language do you always use?
Well, actually, we haven't done, and this is, I was thinking that maybe we can collaborate in that. We haven't done the Monte Carlo approach for this kind of model, but in general, when I do Monte Carlo, I do Monte Carlo because I use Monte Carlo to compare. So this is a method which is, I think, it's faster than Monte Carlo. So with Monte Carlo will give me the right solution. So I use Monte Carlo and I use MATLAB. I use MATLAB because it's free in my university. But now MATLAB, for example, in the industry, is not very well accepted. So everybody now is programming in Python or R. So are now more popular than MATLAB, but I have a lot of things in MATLAB, so I keep going and doing things in MATLAB. So I now have a student that's doing using Python, is doing the simulation. So partially this simulation, but we haven't done yet. So that no result in simulation to compare with our analytic method.
Okay, thank you.
You're welcome.
Any other question or comment? I just for curiosity, I mean, to feed this model, I mean, there are so many variables because there is, the temperature, but also the economic considerations. So it should be really difficult to really handle this type of model, isn't it?
It is, and this is an open problem, so I don't have a definite answer. We start because this is based on the parameters of the model. You're right. So this is it's a very complicated model, and I can mention partial result we have is, for example, we did not exactly for this case, but a similar case, and we did. Generalized method of moment. So we have the empirical moment and the theoretical one, we match, but this is like a 10 by 10 nonlinear equation. So we end up with a lot of local maxima. And what we did, we use stochastic optimization method, simulating annealing, and this kind of method that provides a global optimal, but still we don't have a definite point here. So one thinking, so we are thinking in doing, for example, this, but again, it's the same problem. Is any optimization problem with 10 variables is a nightmare. So it's a hybrid. We'll use a hybrid. Some of so we transform these parameters, and we reduce a little bit the number of parameters, but still have 7 or something like that. Yes, a big number, and it's a problem. So
but nevertheless, this model go beyond, the academic work. They are actually used in the stock market and things like that, or
well, no, it's practitioners. They stick to the Black-Scholes model. They are using the same model that they used for 70 years, and they make some correction to an empirical correction. For example, the hypothesis that the volatility is constant is something that they know that is not true. Well, so they adjust in the middle for this case. So they recompute, they recalculate the Black-Scholes model. So when you talk about the levy process, I wasn't in a project with some guy in a company in the industry. When I talked to him about levy processing, he was very scared. So it's very traditional. So it's not so. And then for Black-Scholes, but with Black-Scholes, so it's easy to estimate parameters. And that is random motion, so you have to estimate basically 2 parameters.
Okay. Well, any other question or comment? Okay, well, thank you very much to Pablo. Really a pleasure to have it here. I hope that well, we will have it sometime when the models have more application, for instance. And well, with this, we are done with the colloquium of the Department of Math at Roosevelt for this semester. So thank you for to being here, and well, have a nice holidays, and see you next semester then.
Thank you so much. Bye. Bye, guys.
Thank you.
Bye-bye, thank you.
Bye.